Now, after a rather impressive first quarter, the cedi is losing ground against its major trading currency, the US dollar, and entering the depreciating mode. What's happening and what does the future look like, especially during this period we are battling a pandemic? Joining me with some insight is economist with Data Bank Research, Aboagye-Wiafe. Great to have you this afternoon on the Marketplace, Aboagye. Let's begin from the impressive first quarter of the year and explain to us what is contributing to what was contributing then to the cedi's impressive performance. Hi, Aboagye, can you hear me?
Hello, Darrell, can you hear me?
Yes, I can hear you loud and clear. So I was asking you to just tell us about.
Hi, Darrell.
Yeah,
can you hear me?
I can hear you. Can you hear me? I don't know if.
So,
all right. Great.
Yeah, so during the first quarter of this year, we had the cedi mounting some strong challenge against the international currencies, and it really appeared to have won the battle significantly when the gains against the major currencies actually hit peak of over 4% as at the end of February. But what we noticed is that from the first week of March, when the oil market entered a price war, there was a collapse in oil price, and foreign investors on our financial markets began to exit cedi denominated bonds and our local currency market. Those movements within the financial market triggered currency pressures, and they started to erode the gains of the cedi to the year-to-date depreciation that we have today. But I should also put that year-to-date depreciation within the African context, where even though we may have lost 1.4% year-to-date against the dollar interbank, we are about the fourth most resilient currencies within our basket of 15 African currencies. And we are doing better than countries like South Africa, Nigeria, Kenya, and Zambia, Namibia, Botswana. And that is quite strong. You know, if you look at those who have beaten us, like Kenya, like Egypt, who have strong reserves position. So I think, in effect, the corona effect on the cedi would likely play through the financial market rather than the impact it will have on our trade balance and current account position.
Okay, so I see that you tell us that, you know, compared to other countries, we are doing quite well. So is it that we are downplaying the depreciation that we are experiencing at this point?
Not about downplaying, but about doing relative analysis, right? Because if you look at the cedi's performance year to date, a loss of 1.4%, you want to measure that against a certain standard. One of the standards you want to measure against is your own standard. So at this time last year, what did I do? At this time last year, the cedi lost over 6% against the US dollar. Same time this period, we've lost 1.5%. Are the losses slower now? Obviously, they are slower. Now measure that against our peers, because we are all confronted with the same global context. So how are their currencies reacting versus the way we are reacting? That can give you an indication of your fundamentals, so that if you don't suffer so much losses, then it is either your fundamentals are absorbing the shock very well, or your
All right, we'll try and get Aboagye to fix that. Okay, Aboagye is back. Aboagye, can you hear me?
I'm sorry, I keep getting calls through.
That's okay, technology. So you're explaining, please go ahead.
Yeah, so I was saying that if you measure our performance against the other African currencies, which face the same context, global context, as we do, it gives you the performance of our currency, and then be able to assess whether it is doing well. Now, it tells you the strength of our fundamentals, and it tells you the robustness of our policy regime. So it is not about trying to downplay it. It is about trying to assess the policy regime we have here and the strength of our fundamentals against those of our peers. And it appears we are holding quite firmly when you do that against our peers.
Okay.
But that is also not to overlook the risk to the outlook. And I must emphasize that there are so much risk to the outlook, particularly from the financial markets.
Yeah, I was going to come to the outlook because, again, we don't know when coronavirus pandemic would be over. And so I guess that right now we are revising our outlook as to how we expect the cedi to perform throughout this year.
Yeah, so then again, the outlook should be looked at from two broad perspectives. One, fundamentals, and two, the way the financial market will behave irrespective of fundamentals. So now when you look at fundamentals, for instance, you look at our balance of payments account, one of the things we noticed during the first quarter of the year was that our export revenues dropped, obviously because of the lower crude oil prices and cocoa prices and our lower export volumes. But what we noticed is that the strong prices we had for gold helped mitigated the downside pressures from crude oil and the rest. And so the decline in our export revenue was slower or smaller compared to the decline in our import volume. So import bills actually fell, meaning we didn't spend as much on imports. So that led to a widening of our trade surplus compared to the same period last year. Fundamentally, we seem to be doing well because of the offsetting movement in the trade account. And so our current account balance is also still in surplus. But then when you go into the financial market, which is reflected by development within the capital and financial account, there appear to be a decline in the balance on the capital and financial account. And that is because you see portfolio investors moving out of our market intermittently into the USD when they see other risks not related to our fundamentals. And to actually give confidence to these investors, the central bank announced that it has gone into a repo facility worth 1 billion cedis, which will be with us for at least the next 6 months. That is going to add to the already $10 billion of reserve that we have to intervene on the market. So whilst the financial sector poses the most significant risk to depreciation, the central bank has also signaled the intention to protect the Cedi through difficult times, through the reserves they have, spot market interventions, forward market interventions, and the repo facility with the U.S. Federal Reserve.
Yeah, and speak of interventions, what else can the managers do, the managers of the economy, I mean?
Well, I think one of the things that is important also is that the central bank is in the mood where it is prepared to inject liquidity into the system to mitigate the downside pressure on growth, which is very good because that's what you see happening around the world. But another important caution is that we need to know what we are spending the liquidity on. If government takes this, the central bank announced they are going into a $10 billion asset purchase program. Now, should government lay hand on this liquidity should be going into productive sectors of the economy, not unproductive sectors of the economy. They should go into ventures that would stimulate growth, that would generate income, that would be able to buy output on the market. But if it goes into pockets and it doesn't generate output, then there will be more money chasing few goods and it can become inflationary and can cause depreciation pressures as well. So the increase in liquidity from the central bank, the authorities must ensure that it is channeled into productive sectors and productive activity so that the response from the supply side of the economy will match the increase in liquidity.
Yeah, and my last question to you would be, because, I mean, whenever we engage economists, we want to know what are the productive sectors?
Well, first of all, you look at the food basket and you take example, a key from what happened when we're going into the 3-week lockdown. When people front-loaded demand for food items, you saw the spike in food inflation. There was a shock to food supply. So very quickly, you want the government to spend on food production, moving us towards food sufficiency or self-sufficiency in food production, so that that side of the supply chain can be worked on and support the increase in demand or the potential spike in demand as we go along when people become apprehensive. And actually, to be very confident or to put forward some confident commentary, we have the Planting for Food and Jobs program, which should serve as the basis to expand on the food production side. So I think food production will be the first thing to look at. Once we achieve self-sufficiency in food production, we can then drive up into the value chain.
All right. Thank you very much for your perspective this afternoon. Courage Marty there with Data Bank. We appreciate your time with us this afternoon.